Evening, everybody. Welcome to today's webinar. I am Rasmeet Kohli, Senior Assistant General Manager from the Investor Education Department of NISM. NISM is a capacity building initiative of SEBI, and we at NISM conduct a wide range of activities at various levels with the objective of improving quality standards in the securities markets. At NISM, we work in five broad areas, which are primarily the long term and the short term academic programs. We have certification examination for market intermediaries. We're into e learning programs and also training programs for working professionals and the academia. In addition to that, we also host from time to time various investor education initiatives. So, today we are pleased to launch the second series on the topic Future Ready Finances Investment Planning for Indian Investors, comprising four episodes, which will be scheduled through February 2026. The first episode being held today, titled From FDs to Freedom, Why Indians Must Invest Smartly. This will be conducted by our speaker, Mr. Jitendra Solanki. The next three episodes will be on basics of investing, investment options, building your portfolio, and how to protect and grow your wealth. To introduce Mr. Jitendra Solanki, he's a registered investment advisor based in Ghaziabad, Uttar Pradesh, specializing in holistic financial planning and wealth management. With over 17 years of experience in the financial services industry, he has been guiding individuals and families towards their financial well being. Mr. Solanki is also an experienced estate planner and provides comprehensive advice on succession planning, wills, trusts, and other aspects of estate planning that integrate financial tax and estate planning to help clients preserve and transfer wealth effectively. His approach emphasizes structured, ethical, and client centric financial advice. Over to Jitendra, sir, for the session, please.
Thank you, Rasmeet. Welcome all participants. And today is a very important topic we are going to discuss. And this whole series is about educating you on investments, what aspect to consider, what is there in investment, where to start. So all of that we're going to cover. But today we are going to cover specifically the fixed deposit. It's a favorite, among Indian investors, and right from our parent, grandparent days, fixed deposits has been one of the most, sought after investment. But as we move ahead, as the time change, as the scenario change, we have to look forward. What are the most efficient investment options which are there? So today I'm going to discuss about how do you move from FD fixed deposit to other options. Yes, from FD to freedom. So basically, moving from fixed deposit to other options and how you can do it. But first of all, we know India is known as a nation of savers. We right from our earlier days, as I was speaking, right from our grandparent days, parent days, we are known for saving, and research tell us that uh, we are onto high savings. In fact, we are one of the most, highest savers in the world, but we are also on a low wealth creation. And the data still tells about what percentage of, the total population is investing into equity markets. I think we are around maybe 3 to 4%. We are investing into equity markets comparison to, if you talk about country like US, where it invests more than 80% people invest into equity market. But primarily, and that's the reason why I'm saying we are a low wealth creation. The wealth creation happens in a different format, and most money Indians lying in fixed deposit, savings, and gold. And in fixed deposit also, and the gold also, the Indians hold the biggest reserves of gold. When I talk about reserve, we are talking about Indian investors. So we hold highest amount of gold and fixed deposit also, and that's why we are very high on savings. uh, but there is a journey to wealth creation, and fixed deposit may not be the best tool of wealth creation. When I talk about wealth creation, I'm not talking about returns, I'm not talking about any other aspect, but simply that if we have to create wealth in the longer term, then is fixed deposit the best option? But why FDs are popular? They are popular because few reasons. One, it gives you guaranteed returns. There is a predictability and steady interest income. So all of us know, that fixed deposit is what interest I'm going to earn at the end of the period. So there is a predictability of returns, and that's why it is, one of the most popular, because we know what's going to earn, and we try to avoid where earning is variable. We do not know what we're going to get at the end of the horizon. A safety principle is protected by insurance up to 5 lakhs. So for us, the safest investment becomes fixed deposit, and that's why we are so attracted towards fixed deposit, because it's the safest product we can have, and safety uh, is probably on a higher priority than wealth creation. Simplicity, easy to open, and straightforward. So what it takes to open a fixed deposit account in today's scenario: you have an internet banking, just on a click you can open an FD account. Or uh, older generations, they would like to go visit branch, and then fixed deposit become the easiest option. And no market risk, not affected by stock market volatility. So fixed deposit have been popular simply because what I am earning, I know very well, and that's what I would like to see. I would like to see what I'm going to get at the end of the period. Safety, it's on the highest safety. It's from a bank till up till 5 lakh. It's secured. But even then, we know that when we are dealing with banks, then banks are those institutions where we do not believe it is going to fail. Simplicity, the most easiest product, and no market risk. I think that makes fixed deposit the most popular investment among Indians. And it's not only for smaller goals, probably for longer goals also, long horizon also, we tend to keep our money into fixed deposit. Even the different interest rate scenarios, and even an 8% fixed return on fixed deposit would attract to us highly. And we investment where we do not know what we're going to get at the end, so your returns are variable. And that's why fixed deposits are one of the popular investment Indians do. But there are problem with fixed deposit, and today that's what we are discussing: why Indians should move, or why we should move from saving to investment. We shouldn't be looking at only savings. We should be looking at investment. Now, what's the problem with fixed deposit? Fixed deposit, we have seen how popular fixed deposit is. So what is the problem with this fixed deposit? Yes, it's safe investment. Interest rate predictability is there. Today, tomorrow, future, you know very well what you're going to earn. Liquidity is too high. So it does have those features, but then it may not be the best tool for wealth creation. And that's where we are going to discuss what is the problem with fixed deposit, why it is not a considerable option when you talk about creating wealth. We're not talking about 2 3 years or 3 years. We're talking about when you are creating wealth in the longer term, why reliance on fixed deposit is not the right option. So over reliance on fixed deposit limits long-term wealth creation and hinders financial growth and flexibility. And that's what I was saying, that over reliance on fixed deposit for all your goals, when you want to plan through fixed deposit for longer term, you want to plan through fixed deposit, then probably it does not hold a right choice. And why it is so? So why FDs feel safe? Let's understand the allure of fixed deposit. Though FDs feel safe, and we have seen why FDs feel safe, but then there is a hidden cost. There is a hidden cost when you are investing fixed deposit, thinking of creating wealth through fixed deposit. What is that hidden cost? So FDs may seem safe, but then their real return diminish. Why it diminished? Because there are two devils sitting on fixed deposit or on your investment, and those are taxes and inflation. So how does taxes beat your returns from fixed deposit or hit your return from fixed deposit? So 5 to 7%, let's say you are earning an interest and you are on a taxability of maximum tax rate, let's say 30%. So what you end up earning? You end up earning 4% return. Now, is that beating the inflation, or are you really going to create wealth with this kind of return? No, it's not going to happen. So that you can think of, that's the hidden cost which is there, taxes and inflation, which is hitting your investment. So FD taxability, if I have to show you through an example, so FD interest rate of 6%, tax slab is 30%, you invested 1 lakh. The end of the day, what you're going to earn? So 30% of 6,000, end of the day, 1,800 you pay, as a tax. So what you earn actually from it is 4,200, which means you post-tax return are 4.2%. And that's where I see that fixed deposit may not be the right choice, may not be a wealth creation tool, because what you're going to get at the end is not something you are looking for. And why 4.2% may not be a very good for long-term wealth creation? It because of the inflation. We have seen the taxes, how tax is going to hit fixed deposit. First of all, the earning isn't interest. And we all know whatever the interest income you earn, that is taxable as per your income tax slab. That is added to your income and you have to pay tax on accordingly. So from fixed deposit, you are earning an interest where the special tax rate is not available. So if you move up in the tax liability, then you end up paying higher tax on fixed deposit interest. And that's the hidden cost which is there, that on paper, the 7% interest might also look good, but when you work out the taxability, then the post tax return is much lower than what you think. And that's what's shown in this example. So you have to look at, when you are investing in fixed deposit, what is the end uh, income I'm going to earn, or income I'm going to get in my hand post paying that tax. The second, so taxation is the first impact. The second is the inflation impact. So it's a double hit on fixed deposit. First of all, the earning is going to hit by the tax you pay, because it's an interest income, and added to your income, whatever your tax slab are, so you are going to pay tax accordingly. And mostly people who are in higher tax slab, more than 20% tax slab, they end up paying, getting very low income in hand from the fixed deposit. That's the first hit. The second hit is the inflation. So inflation also plays a role in impacting your investment. And how does it does that? So it drastically reduces purchasing power. So what you are purchasing today, so for what you are purchasing for 100 rupees today, will not be available for 100 rupees 10 years down the line. It would be available for much higher price. So rupees 100 today would be available, let's say, 120 rupees down the line 10 years. But so what happens if your income, your investment are not going to earn that much amount of money? So you will not be able to buy. Okay. So your purchasing power is also reducing. And that's where inflation is impacting you. And when you add these two into your fixed deposit earning, you actually see that your wealth is eroding. It's not growing, it's eroding. And inflation's what we are talking about, let's say inflation rates, living expenses 5 to 6%, education expenses we know are growing by 8 to 10%, and medical inflation is 10 to 12%. With that high inflation, can we even think of that 4.5% I would be able to meet my financials 10 years, 20 years down the line? No, it's not going to happen. So your earnings has to match the inflation. It has to grow more than inflation. And that's why fixed deposit uh, gets hit by these two devils. I say devils because end of the day they are going to hit your pocket. And inflation has a much bigger impact in the longer term. Tax, you see the impact right from the first year, But inflation, you don't see the impact today, you see the impact after 10 years when you want to buy the same item which you have bought 10 years before. Let's take an example how medical inflation of 10% in 10 years. So a 10 lakh current medical treatment cost is going to cost 25.9 lakh in 20, in another 10 years. If it grows, the treatment cost grows by 10%. Now think of how your income has to match to afford the treatment cost after 10 years down the line. So that's where the inflation is impacting your investment. It is reducing the purchasing power, and specifically education, healthcare cost, these costs are going to come in your life in certain point of time. The education cost will come in when you will have children, they have to go to school and then they have to go to college, their education expenses have to be there. Medical inflation is always there, medical costs are always there. It increases when you reach probably the old age, but today, in today's scenario, we are seeing the medical cost even at a very younger age. So add these inflations into your investment bucket. What at the end of the day are you going to earn is what matters. How much money you will be able to grow. And that's where fixed deposit. So that's where fixed deposit, if it is not earning, probably you are not going to meet your goals. Or let's say example, this medical inflation. So you do may have made a provision of 10 lakh today, but then after 10 years down the line, you have to make a provision of 25 lakh, not 10 lakh, which means your money has to grow and has to reach 25 lakh. Now suppose you invested 10 lakh in fixed deposit, the inflation is 10%, but what you are earning in fixed deposit is 4% after taxes. So what's happened after 10 years down the line, these are two are not going to match each other. And that's where fixed deposit uh, hit you badly when you think of uh, creating wealth through fixed deposit only. So what is the impact on your money? Money grows, but purchasing power falls. Money will grow, with the fixed deposit, the money will still grow, but then purchasing power will fall. And that's what I was saying. Impact of say 6% inflation on rupees 10 lakh. Initial value of 10 lakh over 10 years down the line, it will reduce to 5.58 lakh. After 20 years, it will reduce to 3.1 lakh with 6% inflation. So if your money grows only by 4% and not by 6%, then probably after 10 years down the line, you will be in a loss. You are not growing your money, you are losing money. Why? Because you will not be able to meet your expenses, you will not be able to meet your goals if your wealth creation relies heavily on fixed deposit. And that's why today's scenario, you need to think of investing smartly and not thinking over reliance on those investment which can hit both taxation and also for inflation. So what is the real risk? What is the real risk which we have? Why we are saying, why, as an Indian investor, you have to think of moving from fixed deposit gradually to other investments. So now we do not think of investing into other instrument because there is a fear of market risk. Okay, there is a fear of market, there is a fear of risk of losing money. Their fixed deposit is really safe. Okay, I'll have my capital protected in fixed deposit. But so we have to move from that. We have to move from market fear, to longevity risk. We have to see the risk, cause risk is not of market. The risk is of longevity. What if I, happen to live 20 years more than what I am thinking? And with the kind of purchasing power impact we are seeing, will my money will be really be able to meet my expenses in the next 20 years? I have to figure that out. And that's the real risk we are dealing with today. First, the biggest risk is if the longevity hits, the biggest risk is that I am going to outlive the money, which means whatever money I have generated through my fixed deposit investments, which is not beating the inflation, there are more chances that the money will die out even before my life stage. So if I think of that I'm going to live, say suppose 85 years, and I am planning through fixed deposits, uh, majorly my wealth creation along with gold and saving money more. If I am planning with that wealth creation, there is more probability that my money will end up at 60 years or probably 65 years, which means I'll be left for the next 15, 20 years with no money. And that's the real risk we are living with. And that's the risk we have to address, that I may outlive money. Rising healthcare cost. We are seeing how healthcare costs have risen, and the best example with us today is after COVID, how the healthcare costs have suddenly increased, whether it's premium, whether it's any other aspect, whether it's the treatment cost, how the healthcare costs have risen. And this cost is going to rise in the future. If I am not able to grow my earnings to beat this, then there are more chances that if tomorrow the healthcare cost has a major share in my expenses, then I'll end up the first aspect, which means I'll outlive the money. And that's the second risk we are holding. Long retirement, the longevity. Okay, so longevity is what the biggest risk we are addressing. With the kind of healthcare facilities available, with the kind of development we are seeing, there are more chances that we are going to live longer. And when we are going to live longer, our money has to last longer. And if my money has to last longer, it has to grow, beating both inflation and taxes. And that's the risk we have to address. And that's where I feel fixed deposit falls short of. Fixed deposit may be good for short term, say, but when you talk about wealth creation, I need to address those two devils, the inflation and the taxes. And as we have seen in the last few slides, how fixed deposit is falling short of that. So we have to think of whether we want to save money or we want to invest money. The difference, there is a huge difference between what you save and what you invest. Saving is protecting your capital, and that's in our mind when we are talking about investing into fixed deposit. Nikhil, can we run the first poll?
Sure, sir. I will run
Sahil,
the
yeah,
first poll.
yeah,
Yes.
can we run the first poll here now? So I'll urge all investors to answer
Yes,
the
it's live.
poll, so that we are sure that whatever we are speaking, you are listening to it and you are paying attention to it. And this is a poll. So what you earn from the fixed deposit, what is the type of earning you have from fixed deposit? Is it interest? Is it capital gains? Both, or it's none of the above? I'll request all participant to participate in the poll so that you are well connected with what I am speaking. And surely we are going to discuss all the aspect in the Q&A sessions.
So 66% of the attendees have selected the first option, which is the correct option, interest. 0% has selected the second option. Then 31% of the attendees have selected the third option, and 3% has
Okay,
selected the fourth option.
okay. So as we have seen, the answer is interest, because fixed deposits, you earn interest. There is no capital gains in fixed deposit. Capital gains are there in other instrument like mutual funds, equity. So the answer is interest. Well, good. That's a good participation. And okay, so coming back to saving versus investing, and there is a difference. When we talk about saving, it means we are talking about protecting my capital, and that's what fixed deposit is being considered. uh, yes, we consider fixed deposit also as earning interest, but the biggest attraction toward fixed deposit is the protection of capital. And when my interest is protection of capital, I am doing saving. I am not investing, because investing helps to grow my money over the period of time. And when I have to look at growing my money, I have to look at growing my money over the inflation. So if I can grow my money beating inflation and taxes, I am investing my money. But if I am just going to think of protecting my capital and still earn an interest, I am thinking of saving money. So whenever you are thinking of deploying your money, just think of whether you want to save or you want to invest. So there is a wealth ladder, which is there, and we should follow. Now, what does this wealth ladder talk about? Okay, it's talk about that how it should start. First of all, there is so whenever you are thinking of investing, always follow this wealth ladder. Now, what does it talk about? It talks about that the first point or the first thing to start with is emergency. First of all, prepare for your emergencies. What happen if you have a job loss? What happen if you have a there is a sudden mishappening in the family? How will your family would be protected? So think of first emergency situations, okay, and make provision for that. Buy insurance, or plan out for setting aside for emergency funds. So first of all, thinking of emergency. Then the second step, you reach towards stability. You want stability in your career, you want stability in your money. Unless and until there is a stability in your career, stability in your earning, then only you will be able to provide money for savings. So think of stability, how this stability is going to come. Third is the growth. Now the money has to grow. You have provided for emergency, there is a stability. Now the money has to grow. And when money has, then think of those investment which is going to help growing your money. All investment, fixed deposit, PPF, NSC, all investment help in growing your money. But the fourth aspect, how you're going to create wealth. And that's where you're going to think of the right investment instrument, that how you're going to create wealth in the longer term. Think from that perspective. And when you have created wealth, how can you protect the legacy? So there is a ladder which you have to follow when you are thinking of investing your money, providing for emergencies, looking for stability, then thinking of growth, and then creating wealth, and finally protecting that wealth. So whenever you are thinking of investing with whatever savings you have, just think of this ladder and start right from the foundation. Emergency fund is the foundation, because anything happens, your life should not get hit. You can invest your money, but your investing should not happen in manner that it is hit, any emergency comes and you don't have money, and you have to dip into your investment, into your savings, so cater to emergencies. That should not happen. So lay the foundation, move to the second step, stability, then think of growth. Now I have to grow my money, and I have to create wealth in the longer term. And when we all create wealth, the last step is how to protect my wealth. So always follow this wealth ladder whenever you are thinking of investing your money or investing your savings, whichever way you think of. Beating inflation. The biggest powerful growth strategy when you are investing is beating inflation. If I am not able to beat inflation, we have seen inflation in the past slide, let's say living expenses of 6%. If I am not beating that inflation and growing my money, more probability that I won't be able to buy the same item 10 years down the line, because the item would have grown, uh, the cost of item would have grown, but my money has not grown with the same inflation. And so whenever you are investing, the biggest powerful growth strategy is beating the inflation, that your money has to beat inflation. And that's where equities are one of those growth asset class, or probably I would say, the asset class which helps you beating inflation. I won't go about what return they generate, how it happens. I think we are going to discuss in the other sessions. But equity matters. Equity matters, and we always say that if you are not investing into equities, you are actually having a bigger risk than investing into fixed deposit. Why? Simply because you are not beating inflation. And unless and until you beat inflation, you won't be able to grow your money the way you want to. Participate in growth. Equity is an instrument which helps you participating in the growth of economy, in the growth which is happening. Just think of last 10 years how the equity markets have grown. If suppose I would have stick to fixed deposit and have not participated in equities, can I really grow my wealth? No. And that's where we say that equity participates. When you invest in equity, you are participating in the growth of the economy, in the growth uh, of your country. You are participating in growing your wealth, beats inflation in the long term. To me, equities uh, are the asset class which can help you beating inflation in the longer term. And that's why everyone who is investing his money has to be in equity. We are going to discuss in the future sessions how much, how, what manner. But today we will discuss more on, why, how can you shift gradually from fixed deposit to those kind of instrument which helps you in growing your wealth. And equity matters. Equity matters because that's the instrument which helps you beating inflation in the longer term. And for investors, mutual fund is the best instrument you can have. Why? Simply because you can have a diversified portfolio. You can have different kind of instruments available. You can have equity, you can have debt, you can have gold. So there can be a diversified portfolio. You can have a very efficient risk management through mutual funds and can look for potentially higher returns to beat inflation in the longer term. And that's why mutual fund becomes a very smart investment choice. And that's where the theme of today's session is, how to invest smartly. And mutual fund is that smart investment which I probably believe every investor should be there. So what are the benefits of mutual fund? You get diversification, you can diversify, and we always say that don't put all your eggs into a single basket. And that's where mutual funds help you with different categories, different asset class. You can actually within mutual fund, you can diversify your portfolio. There is a professional management you get. So there are fund managers who are managing it, systematic investing. So it's not required that you need to have a big high capital to invest. You can invest systematically in that. It has highest liquidity which is available. So mutual fund becomes a very good investing tool which allows you for an efficient risk management and potentially higher returns to beat inflation in the longer term, and which is allowing you to create your wealth. And SIPs are the, I think in today's, we all know, everybody of us keep on listening, hearing news that how money is coming into SIPs, how investors are investing into SIPs because they believe that SIP is the method of growing your money in the longer term, beating inflation. SIP is not a product. SIP is a way of option of investing, systematic investment planning. So one way is you invest your lump sum money. One way is you are a salaried individual. You can generate savings only on a monthly basis, but still you want to participate in the market. That can happen through mutual fund and that can happen through SIP, systematic investment plan. One, it encouraged discipline, consistent investing, ease of investing. The money just go out from your bank account and you are investing into specific mutual fund scheme, which helps you in participating in the growth and help you beat inflation. So this way of investing helps you build wealth gradually and you actually are benefiting from the power of compounding. The magic of compounding and investing is all about, I think, compounding. The way you can compound your money in the longer term, the more you compound your money, the more wealth you create. Why we hear so many investors generating so high wealth? Because they were able to unlock the magic of compounding, and that happens through time and patience. So it's not about 1 year, 2 years, or even 5 years. It's about time, patience you need to have when you are investing for the longer term. And I think investors who create wealth, uh, we talk about Warren Buffett, we talk about Rakesh Jhunjhunwala. Yes, they did have expertise which we all do not have, but one thing they really have and was time and patience. They had patience to invest into equity markets and hold the money till it creates wealth, till they unlock the wealth, till they benefit from this magic of compounding. The power of SIPs, why I am so attractive toward SIP is because all of us, who are especially salaried individual, we do not generate lump sum money so heavily. What we can generate is monthly savings. What is the way of this monthly saving which can go into equity market and still benefit is the through SIP, systematic investment planning, which creates a good amount of discipline. And just look at SIP of 10,000 per month invested for 20 years. Let's say at the probable return of 12% per annum can reach you to 1 crore plus corpus. So you are generating corpus by investing 10,000 per month. Okay, what I mean, these are all calculation which just shows the power of compounding which happens in the longer term. And spread this 20 years to 30 years, talking about your retirement goal, and you can think of what amount of wealth you can generate in the longer term. And that's where the power of SIP is. And systematic investment plan is one of the best ways to create that discipline and invest the money. And I think when you are moving from fixed deposit to mutual funds, what also SIP allows you that you do not have to invest with a high capital. You can start with very lower amount and still get the benefit and move gradually your money. But SIP is all reward of patience. The long term investing is reward of patience, and patience in investing is very crucial because you are going to create a longer term. It's not a short term story. It's not a story of 3 years or 4 years. It's going to be story of 15 years, 20 years when the wealth would be created. And compounding is all about the long horizon. The more you give your money to compound, the more wealth it generates. And that's where power of compounding is, that give more time to your money to be invested in markets, and that's where you can generate wealth in the longer term. So that's how you do it. That's how you invest your money. Fixed deposit, we have spoken about how, why fixed deposit may not be an ideal investing tool. It may be a good saving tool, but it may not be an ideal investing tool. Nikhil, can we run the second poll here?
Sure, sir, I'm launching the second
Sorry.
poll.
Yeah.
Yes. Yes, it's live.
Yeah. So how is earnings for fixed deposit taxed? How are FD, whatever you earn, how FDs are taxed? Does the it is added to the depositor income? Does the earning tax at a flat rate of 12.5%, or they are straight away taxed at maximum tax rate, or none of the above, they are taxed differently? Participate in the poll and let us have answers from participant, and let us see what you think of this. It's good that all of you are participating in it. And taxation, everybody should be aware of what is how your FD going to be taxed.
Sir, I'm sharing the results.
Yes, yes, please.
So 57% of the attendees has selected first option, then 23% has selected the second option, and then 10% has selected the third option, whereas the fourth option is selected by the 10% of the attendees. And the correct
Okay,
answer is
okay.
first one,
Yes,
which is
added to the
selected.
depositor income. So FD, what you earn is interest. FD earnings are called an interest income, and all interest income, whichever mode you earn or whichever instrument you earn, not even from FD, you have NSC or any other instrument you have, whatever interest income you earn, the interest income is always added to your income and taxed according to your tax slab rate. So whichever 10%, 20%, 30%, whichever tax slab you are, it is counted as your income and taxed accordingly. Let's have the third poll also.
Sure, sir. I'm launching the third poll.
Yeah,
Yes, it's live.
yeah. So what is the biggest risk in retirement years? Is it longevity risk? It is relocation, not able to work, or all of the above? What is the biggest risk? What is the biggest risk? Because we are talking about money, we are talking about investing. So when we talk about investing, what is the biggest risk in retirement years today?
Yes, so I'm sharing the results.
Yes, please.
Yes, so the result is that 44% of the attendees have selected first option, then 3% of the attendees have selected second option, whereas 14% of the attendees have selected the third option, and 39% of the attendees have selected the fourth option. And here the
Yeah.
correct answer is first one.
First, so we are talking about the biggest risk. Yes, there are risk of relocation. We might have to relocate to other place. There is a risk of that I'm not able to work. But the biggest risk in today's scenario in the retirement years is the longevity. I have done all planning, with the age of, say, as I was talking about, 85 years. What if I live, more than 90 years? The medical, the health infrastructure and everything is so good that it helped me living another 10, 20 years. That's where the biggest risk is, and that's where the money has to grow substantially, and it has to grow to a certain stage where I can cater to that risk. So the biggest risk is longevity risk. Okay, so coming back to our session today, so common mistakes. We all plan out our investment. Yeah, we are talking about one mistake where we plan solely through fixed deposit, but there are also other mistakes which happens when we are making our investment, and it's always good that we can recognize what are those investment mistakes. And sometimes we always say, that the biggest learning happens in the market happens through mistakes, which means when you make a mistake, then you come to know that why this was not a good idea. But all of this is education webinars is all about educating you before and not letting you commit those mistakes which have been done by other investors. So what are the mistakes? Everything in fixed deposit. We are talking about fixed deposit and solely planning through fixed deposit. We have seen how planning everything through fixed deposit is not really a good idea. It can lead you to a situation where you do not have money at all when you plan everything. Stop SIP. SIP is a tool to invest. Everything is about power of compounding. And when you stop your SIPs, thinking of, it is not working, or, thinking of those market scenarios, then probably you are making a mistake, because end of the day, your SIPs is going to help you generate wealth in the longer term only when you stay invested and benefiting from that. And the last is the chasing returns. When you make investment based on the returns, okay, those instrument has given handsome returns in the last 4 years, so why not let me invest everything into that. Today's scenario, if I just talk about, we are talking about gold and silver. Now think of when you make a mistake of investing everything into gold and silver because oh, so handsome return. That's the biggest mistake you do, because we will see in the future sessions how every investment option you think of has its own characteristics, and every time single investment is not the winner. It's all about long term investing. Who is the winner in the longer term? So investing without a plan, just ad hoc investment. But lot many people, I've seen when they commit mistake or just investing ad hoc. Tax season incoming, let's invest into insurance. No, this is giving good return. So ad hoc investment without a plan, reacting to market fluctuations. Based on market, you stop your SIP. Then something happens, you do, withdraw the money. So reacting to those fluctuations, be fearful. No, it's not fearful. It's about understanding the investment journey and be in it, chasing past performance. You chase past performance and invest, accordingly. No, that's not the best option. And lack of diversification. Not all eggs into one basket. So not everything into fixed deposit, not everything into markets, not everything into, some other instrument, but diversifying your money. So these are the mistakes which does happen, which hinders the growing of your money, which hinders the wealth creation, and that we should be aware of. Avoiding SIP mistakes, consistency in SIP is crucial, even during market dip, to ensure long-term financial growth. Markets will go through different scenarios. There's some dips will come, then there will be a recovery phase, then some information-based news will come, then you will see another phase. Okay, so the scenarios will change and it may change drastically, but the crucial is that your SIP investment stays. When gave an example of 10,000 per month, reaching to a 1 crore plus in 20 years, it was with an assumption that your SIP investment continues. You do not stop your SIP investment. And that's the biggest SIP mistakes which happen, which we should follow, that we should not stop our investment whichever way, because we are focusing on the long-term wealth creation. Chasing returns, no, it should not happen, because when you chase return, you want quick gains. The wealth creation should happen in a span of 1 year or 2 years. And when you do short term thinking, then there is an impulsive decisions, and the biggest mistakes happen. And we are witnessing, we are all seeing, today we read news, we hear, we are seeing how these chasing returns, investors are committing mistakes on that. Okay, everything, investing everything based on what happens in last 1 year, and we are seeing the pitfalls. So that should not happen. Allowing your investment with your life goals. Your investment should happen with your life goals. Okay, so when you think of investing even in a fixed deposit, have you aligned it with your life goals, and have you seen whether it is going to meet your life goal or not? So you have financial goal, education, home ownership, retirement. It's important that when you do investment, these are not ad hoc investment. These are aligned to your financial goals, because when you align with your financial goals, two things you get. One, investment horizon. So you are for a long haul now. Okay, you are not for 1 year or 2 years. When you want to meet education in 15 years time, you are there for 15 years. So you will choose investment accordingly. The second, you will balance your risk. Okay, you are not going to put everything into that, because everything into fixed deposit, because you know that this is not going to meet my financial goals, education which is growing by 10%. So when you align your investment with your financial goals, you are able to think more holistically and more wisely. Achieving key milestones requires careful financial planning and investment strategies. Your investment strategies should be based on what goals you want to achieve from it. Determine your time horizon, risk tolerance, allocate assets strategically to meet each financial goal. I was talking about that when you have a financial goal, time horizon is already decided. Education is 15 years down the line. So I'm going to be there 15 years. So I know very well it's a 15-year horizon. Now I may assess my risk tolerance. In these 15 years, how much volatility can I see? Okay. And based on that, I am going to allocate my asset. So is there an instrument which help me in growing my money and meet that financial goals with this beating that inflation? When you plan for your goals, tax and inflation you does take into consideration, because there is a inflation angle to all your financial goals. Asset allocation. So don't invest all your eggs into one basket. Okay, do an asset allocation: short term debt, long term equity, gold, other asset. Just an example how you can allocate your asset. It's just an example to show you, okay, something is in equity, something is in gold, something is in debt, something in some other instrument. How your risk tolerance comes out, you can allocate your asset. But asset allocation has proven to be the best investment strategy one you can have in the longer term. Okay, can I run the next poll here, Sahil?
Sure, sir. I'm launching fourth poll. Yes, it's live.
Okay, so what are the benefits of mutual funds? Is it diversification? Is it professional management? Is it liquidity? Or you get all of these uh, in mutual funds? So let's participate and vote and understand whether we have understood what I have been speaking for the last 45 minutes, whether we have understood how much all of us know what is mutual funds?
So 81% of the attendees has selected the fourth option, which is the correct option, and 11% has selected the first option, and 8% has selected the second option, whereas none of the attendees has selected the third option.
Wonderful. Which means most of us know what is mutual fund. And I think if most of us know what is mutual fund, then most of us should be investing in mutual fund. That's wonderful. So transitioning to investment, what is a practical step, to a successful shift? Start small. Begin your investment journey with small steps. SIPs, kind of an investment option, allows you to start with a small amount of money. With a 500 rupees per month, I can start my investment. Look at NPS, I can start my investment with 1,000 rupees per month. Start with these small steps. Take these small steps, then gradually grow your contributions. That's the best strategy you can have when you want to participate in the growth story, when you want to participate in the equity markets. Diversify gradually. Don't put right in the first way everything into it. Diversify gradually. Okay. Mixing various instrument. What is diversification? Mixing various investment instrument. Right. All investment has their own characteristic. So diversify gradually, not suddenly not shift, from fixed deposit from tomorrow you start shifting everything into mutual fund. No, start gradually. Start something small, watch it for 1 year 2 years, then add something else. So like this, diversify gradually. It will help you understanding more about your investment and understanding how it is really going to benefit you. So when you gradually diversify, it helps you in meeting your financial goals more efficiently. Financial freedom is all about embracing a life of choices and securities. You are able to do what you want to do. You wanted to grow your money, you are able to grow your money. You wanted to do something, you are able to do something. That is what is financial freedom. Okay. And investing is all about journey. Transitioning from fixed deposit to smart investment leads to more secure financial future and independence. Unless and until your financial future is secure, there will always be a stress in your mind, and if any of you have been investing through fixed deposit, the stress would have been, already coming in. So it's all about transitioning. The journey is all about transition. When you are haven't considered these investment instrument, then it is a transition phase which everyone has to go through. So make it a transition phase, make it a journey. Learn while you are investing, invest gradually, diversify gradually, and make those smart investment decisions which helps you meet your financial goals. I'm saying financial goals because when you identify your financial goals, you actually take into consideration your inflation, taxes, and whatever risk which is going to come into the future. And when you have taken it into consideration, the choices of your investment are going to be much smarter. Yes. So that was about fixed deposit, moving to other investment instrument, especially, from fixed deposit to markets, how you can make that gradual shift. It is important because FD alone would not let you grow your money. And two devils, inflation and taxes, everybody of us have to address. And that can be addressed by the way, we have spoken today, shifting your money gradually, not at one instant, and diversifying your money following an asset allocation approach. Happy to take question and answers now. Probably, Sahil, we can run the last poll we have.
Sure, sir. I'm running the last poll. Yes, it's live.
Okay, what are the common mistakes in investment? Diversification, asset allocation, goal-based investing, or chasing returns? Let's see how many have these right answers. I've been speaking on common mistakes for the last 15 minutes, and whoever is listening should have this right answer. I think all of us should have the right answer now. Okay, Sahil, result.
Yes, sir, I'm sharing the results. So 5% of the attendees have selected first option, whereas 15% of the attendees have selected second option, and none of the attendees have selected third option, and 79% of the attendees have selected the fourth option, which is the correct option.
Okay, yes, chasing returns is a common mistake. Diversification, asset allocation are investment strategies for smart investment and not a mistake. So you have to choose those options. You have to choose diversification, think of asset allocation, think of goal-based investing. But chasing returns is the biggest or the common mistakes which happens in investment. Okay, I'm happy to take question and answers.
Okay, now I request attendees to ask their question in Q&A section if they have any, so that you can answer those questions. There is one question, sir, in Q&A section.
So how is index funds in mutual fund? Well, we are going to talk about. I'm not going to say more on index fund here now. Okay, they are passive strategies. So you have two kind of strategies in mutual fund: passive and active. Passive mutual funds are one way where you do not have a fund manager actively managing it. They mostly replicate the benchmark index they have. Active mutual funds are those which replicate which fund managers are managing it. So you have both passive and active, and index fund is the passive kind of an option. Okay. So we'll talk about in our coming, webinars of this series. We're going to talk about on this. Can I invest in mutual fund a random amount regularly? Yes. SIP is an option. That automatic, debit from your bank account to mutual fund is an option. If you want to invest yourself, yes, you can do that random amount regularly basis, monthly, quarterly, half yearly, whichever way you choose, you can invest that amount. When we do SIPs, it means we putting our money in mutual fund. So SIPs is an option. It calls systematic investment planning. Not only mutual fund, every investment avenue where you can put money on a periodic basis or systematically will be called as systematic investment planning. FD also you have this. They are called by name of recurring deposit. It's the same. You do monthly investment into fixed deposit and they call it recurring deposit. But SIP is an option. Okay, you can put into mutual fund. You can have it in NPS. You can have it, whichever where. But yes, largely SIPs work where the investments are more volatile, and that's where SIPs work better in option. This kind of an option works good in mutual funds, especially the equity mutual funds. Which is good between APY or NPS? I think we have the webinar coming on different investment options. We are going to talk on these two in that webinar.
Yes, I think we have answered all of the questions which were asked in the Q&A, and it's also 5-1, so I think we can end up this session now.
Okay. Thank you. Thank you, participant.
Thank you so much, sir. Would like to extend a heartfelt thanks for taking time and speaking at the webinar.